So what should the Private Equity Growth Capital Council do to ensure its effective voice in Washington? First of all, the Private Equity Council is a good thing. I counseled with some of the people involved in forming it. It needed to be done. Private equity was kept kind of in the shadows and kind of maybe they won't notice this for way too long, and that will never work. This is a complex world, and the Constitution says the people have the right to petition their government for a redress of grievances, and those organizations, those industries and companies that do not petition the government and form a collective voice on the issues of legislation and policy and regulation will be steamrolled. So everybody has a trade association, and private equity needed one. In my opinion, the Growth Council should expand, and in my opinion, and I hope I don't step on toes, but I think starting with the largest was a good thing to start, but it needs to be expanded because all the issues from the large or the small are all the same. My Financial Services Roundtable, we started in our new iteration in 1999 with exactly that view. We decided that the industry of the large financial services industry is first of all size matters of a certain size, but we didn't limit it to just the big four or the big five. We set the threshold as about 100. So our choice was about 100 of the largest financial services companies. Feels and is about right. And it brings enough diversity of views into the organization so that they're not up there just representing the big guys. But the big guys have the golden rule. Who has got the gold makes the rules. So the big guys have a properly proportional voice. So my advice is to be more active, to do more fly-ins, to come to Washington more often, to be open and transparent, and to state your case fully and completely and regularly using the breadth of the industry, not just some. What's the view of the Roundtable on the Volcker Rule? The Volcker Rule is in dramatic need of reform. It is a mess the way it came out. The underlying concept of it was that insured deposits should not be used to make proprietary trading. They're already not used for proprietary trading, so we should have sort of restated the obvious. So it all got tied up with those who longed to reinstate GlassSteagall, and it was never clear who won that debate because the Volcker Rule turned out to be so fuzzy as it's virtually incomprehensible. So I think it will be and should be revisited. Some form of it will survive because nothing in the federal government ever goes away. It just kind of recycles. But I think it's in dramatic need of revisiting. The Volcker Rule was born, to tell you the kind of the Washington insider, was born one week in which the people say, and I don't know this, well, I do, well, I'll just say people say, that President Obama's ratings and polls were down, and there was apparently some kind of a poll that indicated that if you beat up on the big banks, then you can raise your ratings, and I don't know that President Obama knew that, but somebody knew that, and so they said, how can we do that? And they called up Paul Volcker, and literally without any policy consideration with the Secretary of Treasury or with the Treasury Department, Paul Volcker showed up at the White House the next morning and announced what he had proposed as the Volcker Rule, and thus it became statute. It was not particularly well liked in Congress, but the Democrats in Congress felt like they had to go along with it. So record capital, how much of that is accounting changes on the old toxic assets? Well, you're CFOs, so you know more than I. I don't think it is. I think the capital is a result of earnings, and earnings are up. And a part of the earnings is if you have a loan that you had to write down and then you reinstate it. Well, that would be part of earnings. But I think capital comes from earnings and also from raising outside private equity. And the financial institutions, the large banks, have raised a lot of outside private equity. Some of them are not happy about that because it diluted shareholders, but they had to do it. So at the end of the day, if the regulator comes in and says your capital is too low, go out and raise equity. Whatever your share price is, you have to go do that, public or private, by the way. So I think it's earnings and outside equity rather than a restatement. Why don't we hear much about MF Global? I was thinking that we heard a lot about MF Global. It was I don't know the details, but it really looked like a mess. And I don't know how they became. The question is, how did they become a primary dealer with the New York Federal Reserve? I don't think anyone knows exactly how you become a primary dealer with the New York Federal Reserve, and I surely don't. So it was a mess. It is a mess, and somewhere along the way, it will those lost assets will be found, and bad things will happen. It was a bad situation. No. I have no sense of. No sense at all that anybody should be forgiving of MF Global for what they did. It was a disaster from start to finish. Carried interest legislation. I should probably just stop now. So the corporate. So the bottom line is, I'll start at the end and then go back. I think that carried interest is going to be visited. I think it's on the list on the short list of most people in Congress sort of favored things that they can use to gain revenue, and I know that's not music to your ears, but I think it is on the short list, and it's likely to be revised and revisited at some point in the coming years. On a broader question, though, I think that the corporate tax structure will be revisited, will be reformed. I think that there is a general understanding in Washington and in Congress that we as a country cannot survive, cannot be competitive, cannot be robust with global growth with the current 35% corporate tax rate. So the 35% corporate tax rate is the highest or second highest in the world, has to be reduced, and we have to find ways to allow companies to bring and encourage companies to bring capital back onshore, something different than the kind of one-time only bank holidays that we've had in the past. So there's an awareness and an understanding in Congress that those two things must be done, and to lower the corporate tax rate, that means that you have to eliminate tax preferences. And everybody wants to eliminate tax preferences as long as it's not me or thee, but make it the fellow behind the tree. That's the way we raise taxes in Washington, is we tax somebody else. Well, there is no somebody else. So tax preferences, all tax preferences, corporate tax preferences are on the table. Those that have them, which is most, don't like it, but that's the cost, that's the pay for corporate tax rate reduction. So my sense is that carried interest will be in that mix somewhere, and that's why you should join the private equity council. What's our view on the carried interest tax rate? Some of my friends are for it, and some of my friends are against it, and I'm with my friends. Is there a snowball's chance in hell that the DoddFrank will be taken up by Congress anytime soon? Absolutely. Not everyone, most people in Congress will tell you, the leaders in financial services, that DoddFrank needs to be revisited. 2,300 pages. Within a week after Dodd-Frank, people said, okay, at least we ought to have technical amendments. So it's only the politics that it is tied to. You get accused of trying to repeal it if you try to reform it. It's only the politics that stands in the way. But people in Congress are serious patriots, and they understand that their job is to write the statutes in a way that will work for the American people. So I think Dodd-Frank, my prediction is, in 2012, we'll have a series of hearings. The hearings on individual elements of Dodd-Frank have already started, the Volcker Rule and other things. What we're urging is that the Congress begin hearings and do it kind of in the cold, clear light of day. Try to take the politics out of it and figure out what about Dodd-Frank needs to be revisited. Dodd-Frank was written pretty fast, and it's quite massive. It's a total rewrite. And I think there are elements all over it that need to be rewritten and revisited. Some of them, like Durbin, just need to be repealed, but most of it needs to be, and I think will be rewritten. We sent the Roundtable. Just within our group, we sort of started with that view, but even within our group, it took us about 8 months to be able to prepare an 8-page letter of what ought to happen with Dodd-Frank, and we did that just last week, actually, sent it to the congressional leaders, and they were all too afraid to respond to the letter because it's politically difficult. Nobody wants to be accused of going back to the bad old days, or the toxic assets, and or the too big to fail, or systemic risk. And yet that's Congress's job, is to review what's right about it and what's wrong with it, and go from there. Why did the government allow Citibank to sidestep GlassSteagall? You know, good question. Citibank, GlassSteagall was fundamentally, this is my view. GlassSteagall, and I was in Congress in the 1980s in the House Financial Services Committee, and we knew it then. GlassSteagall was fundamentally broken. It was more, it had more holes than Swiss cheese. There were more, all of the GlassSteagall, all of the so-called firewalls were unworkable. So I remember I made a speech to a group of independent bankers in the Rio Grande Valley in 1985, and they all looked at me and they said, "We don't want, we don't want any investment banking, and we just want to be banks, and just leave us alone." And I said, "Well, who's your largest customer?" And they said, "Well, we're not going to tell you." I said, "I'll tell you. It's Othel Brand, the largest producer of produce in the valley." And Othel, one day, his wife is going to get him to take her to London, and he's going to discover that in London he can borrow money a lot cheaper on a lot better terms from the investment bankers in London than he can in the Rio Grande Valley, and you're going to lose him as a customer, period. And they said, "Is Othel really going to find that out?" I said, "Well, eventually he will." I remember I went to one bank with a 22,000-foot floor plate in 1999, walking through the back office of the this commercial, quote, commercial bank with GlassSteagall. The GlassSteagall is still in effect. And I walked in, and halfway across the floor, the guy escorted me, said, "Do you want to see our investment bank?" I said, "Sure." And he said, "Step up over that ledge." And there was a 6-inch step, riser. So I stepped over the riser. He said, "Now you're in the investment bank." The federal regulation, the Federal Reserve regulation said, and I'm not making this up, said you have to have a 6-inch vertical separation between your commercial bank and your investment bank. And so they just built a riser. And then he said, "By the way, do you want to see our overseas bank?" I said, "Sure." And he went over and turned on a computer that was sitting in the investment bank. He said, "There's our overseas bank." So GlassSteagall was fundamentally broken for a lot of reasons, economic reasons. Sandy Weil went in and bought it using an insurance company to buy it, and then went to the Fed and said, "Look at what we've done. What can we do about this?" And the rest is history. And the Federal Reserve says, "Okay, it's going to be bad if Congress doesn't reform GlassSteagall, but let's give it 2 years to see if Congress does." And the result was Gramley Spliley. So I don't think we're going to go back to GlassSteagall. I don't think it's possible. I don't think we want to, and I think we damage our economy a lot if we did. I have no idea about the disclosure of non-audit fees paid to your audit firm, but I'll look that up and come back on my next speech. Some of these questions I just don't know the answer to. Let me just keep working. Will the rating agencies face a day of reckoning? So a lot of both my members and others in the industry are quite angry at the rating agencies for having missed it. I take it, having missed the crisis and the ratings, I take a bigger view than that. This is my opinion. So a lot of my companies have said that the rating agencies were sort of the source of the problem. I think everybody had a piece of the problem of the systemic risk. I think the rating agencies did miss it. The lenders missed it. The regulatory agencies missed it. The borrowers missed it. The securitizers missed it. The pension funds missed it. All the mortgages were insured by an mortgage insurance that was regulated by the insurance commissioner of the state of Wisconsin, and they missed it. So I think everybody missed, and it's to our regret. I mean, clearly it caused a gargantuan and a very harmful economic crisis. But everyone missed the systemic risk, and I can't so I cannot justify or apologize to the rating agencies for missing it. But I have to say, I had a call my first wake-up call was in March of 2007, and it came from a buyer, an investment bank, of $1 billion of an asset pool, mortgage asset pool. It was outside of New York, and this investment bank had decided that it was time to sort of get in on those big returns of the mortgage pools. And so he got an option from one of the companies that subsequently went broke. Got an option for $1 billion mortgage pool, and sent his team to New York to do due diligence. And they called back the first day and they said, "Boss, there may be a problem here. I don't know, but the seller, this big investment bank, told us that we're the first due diligence team that they've ever seen." Now, they were young, in all fairness, but nevertheless. And he said, "Okay, we'll go ahead and do due diligence. Call me back." And they called back on this was on Monday. Called back on Wednesday and say, "We've priced this pool to buy it, assuming a 94%. The 94% of the mortgages are good mortgages, only a 6% delinquency, and our initial calculations is it's 72% good mortgages. So what should we do?" And this guy said, "See if you can get a return of your room deposit, and I'll lose the option money and come back." So everybody kind of was in a bit of denial about those mortgage pools that went securitized and kind of infected everything. The rating agencies missed it, but this big investment bank missed it, and everyone. And then you start with and let me tell you one other systemic risk. The regulators missed it too, as did and they knew it. So the regulator, the OCC regulates national banks, okay? And they regulate for safety and soundness and for other things, but for safety and soundness. And there were actual conversations with the OCC to national banks that said, these mortgages that you have originated don't have proper underwriting, which is a nice way of saying that the borrower cannot afford to repay the mortgage. And so therefore you can't, and therefore here's the problem. The OCC said, therefore you can't own them. And the bank says, "We don't plan to own them. I'll sell them right now." Push the button, and they were sold. The mortgages didn't go away. The regulator, the OCC, did not say change your underwriting practices to issue originate only good mortgages. Instead, it was this silo mentality of you can't own them, but not that you can't originate them in the first place. And that is the crux of the systemic risk. And that's why DoddFrank in the systemic risk regulation that's the positive part, is to sort of create the whole system that's responsible. Who should go to jail for credit crisis? Anyone who is involved in criminal activity should go to jail, but people that were involved with bad business decisions should lose all their money, as many people did. But it's not a criminal offense. And do I think that crimes were committed by bankers? Actually, by and large, not. I mean, Richard Full did not set out to lose $30 billion of his personal wealth. It turned out he did, but that wasn't his goal. So I don't think it was so much crime as just extraordinarily bad judgment and a sense of denial by all the players involved. And let me tell you, and I take personal responsibility. I'm the head of a trade association, and I missed it until the summer of 2007. And by the time our group got to it, I brought it to my board. My board focused on it. By the time we got to it and figured it out, we did make some, in fairness to my companies, they did make some pretty massive corrections pretty quickly over the space of 6 months. But by that time, not only were the horses out of the barn, they were out running around in the field, and the barn was burning down. One last comment. That is to say, all of this is decided, both inside the Beltway and outside the Beltway. All of these issues are decided by democracy. Democracy, and I know many of you are involved in politics in your hometowns and your communities, but you're not as involved as you ought to be. So all of these issues will be decided by the elections in 2012 and beyond, and by people who speak up. So democracy is not a spectator sport; it's a participatory sport. So think of being in a football field in the stands, watching two teams, red and blue, going at it. Okay, well that's not what democracy is. Democracy is those people that are in the stands watching the game I'm sorry, have nothing to say about the outcome. It's just interesting to kind of watch what are those people doing, but it's only those, but in a democracy as a sport, everybody in the stands can get out of the stands and walk down and join one of the teams. And you can switch teams from time to time. So it's not 11 on one side and 11 on the other side. You can have 11,000 on one side and 11 on the other side based on who shows up to work. So the true story of the outcome of this is the outcome will be decided by you and your families and your friends and your neighbors by whether you choose. And by the way, it goes way beyond voting. Less than half of the American people vote in the first place, but it's way beyond voting. It is meeting your candidates, asking them questions, saying what you think, going to town halls, inviting them to your home for a campaign coffee, making out a financial contribution, putting a yard sign in your yard, sending a letter to the editor, issuing a blog, sending a letter to congressmen, and doing all those things. So those that speak up will be heard, and those that don't won't. So I urge you to participate in the participatory sport of in this coming year. Thank you very much.